Welcome everyone to another episode of the High Performance Success Podcast. My name is Jason Burke, your host. Today we have the pleasure of having Joseph Scorese from Lending One with us as our guest. Welcome, Joseph.
Thank you, Jason. Good morning. How are you?
Great. Well, before we dive in, I just want everyone to know a little bit more about your background and the story behind Lending One before we get into really diving into the real estate, what's going on with the real estate market.
So basically, Lending One is a division of Blackstone Capital, and we are a hedge fund. So we're asset-based lenders. So we're not a traditional lender. We're not a hard money lender. We're kind of right down the middle, providing debt financing for rental loans, 30-year fixed, multifamily 5+ units, and/or mixed use, 30-year fixed. We look at fix and flip, fix to hold, the ultimate Burke strategy, new construction, blanket loan portfolio lending, as well as revolving construction lines of credit. So we're identifying and relating to strictly investment financing for investors throughout the country. We're technically licensed to conduct loans in 46 states. The only 4 states that we don't do lending in currently is Nevada, South or North Dakota, and Alaska. So every other state we do provide lending in.
No, that's fantastic. Now, where do you see the market go as far as the foreclosures and the moratoriums, and where do you see that really heading as we head into the new year, and how that's going to affect supply and demand?
Well, I think it's not going to be very heavy at all right now. I think because of the government involvement over so many years during COVID, they're finally getting their tentacles out of there and allowing the asset managers and the banks to do what they're supposed to be doing, and foreclosing on the pre-foreclosures prior to COVID-19 and the current foreclosures that are in play. And I think what's going to happen is you're going to see a trickle effect over the next 12 months. And it's going to be by location to location. And I think really you're going to see the heavier flow of foreclosure REO activity sometime around this time next year, going into 24, where you're going to see potentially a true buyer's market. I think your auctions, sites like auction.com and Hubzu are going to be pretty busy this year going into next year, but you're not going to see the full impact. It's going to be trickles. And I've been recently attending several bank REO foreclosure asset manager conventions, and I've basically heard the same thing directly from trustees, asset managers, and other REO realtor specialists that are out in the field throughout the country.
No, that's great. So tell us, when do you think we'll switch completely from a seller's to buyer's market? Because we're kind of in that process now, but what's your take on us when we're really going to see across the country or in certain sectors of the country really become more of a buyer's market? Where
I
it's
think
going to
you're going to see an attrition of real estate professionals, both on the lending side and the real estate agency side, over the next 6 to 8 months. Individuals getting out of the business because the volume is not there. So I think once you get a more realistic base of realtors that are going to be realistic with their clients and realistic with pricing, you're going to start seeing leveling or even decreasing on values, hopefully over the next 6 to 12 months. And I really don't think I don't think there's going to be a full-blown buyer's market, probably close to 24. I think you're going to be very, again, the demand is still there for home ownership in some landscapes, depending on where you're looking. If you follow the migration reports throughout the country, obviously 6 of the top migration cities were in Texas, 10 were in Florida, a couple were in the Carolinas, a couple were in Wisconsin, and those are based on urban activity where people are getting out of certain urban cities and moving into hopefully a safer, better environments, barrier of entries. You also have the restrictions lifted of working virtually, where there was restrictions typically with a lot of companies, you had to live within 90 miles of where you worked. That restriction's been taken off of almost every HR letter that's been issued for employment. So that's also going to be a shift of where people are going to land and working and living, from a better barrier of entry of acquisition to buy homes. I think also the hybrid work environment is going to allow changes in suburban, rural to urban markets as well over the next 12 months. So I see all that combined will put us into a buyer's market probably late next year into 24.
So where do you see the Fed hikes? How you see that's going to affect interest rates going to affect the real estate market, and where do you see that going?
Well, I think it's definitely impacting the cost of money with traditional lenders, credit cards. You're seeing a higher tick up in foreclosure of vehicles right now because they're paying exorbitant rates on buying cars. So I think you're seeing rates move up above 7% recently. You're probably hit about 7.18 on Friday closing, and that was the second time in the matter of a week that the rates peaked over 7%. I think till we get inflation under control, which the media is telling us it's 9%. I personally think it's somewhere around 14 to 18%, depending on where you're at as well, and that's based on location. I think till we get that inflationary rate down to 2-3%, the Fed has to raise the rates. I mean, if you listened to Fed Chair Powell and at the Jackson Hole, it was only an 8-minute conversation, but he brought up the Fed chair from the late 70s, early 80s twice in that conversation. And if you look at history and economic data, that Fed chair raised the Fed rate up to 20% to level off inflation because it was so bad. So again, I think we're still looking at 3 more Fed hikes on the rates, I think, over the next 12 months. I think it's necessary to stabilize the inflationary environment. We printed paper of money that we did not have, and it created a very large tunnel of inflation where we have to dig through now.
No, that's a great point. And how do you think the inflation is affecting real estate investors and the buying decisions when it comes to properties? And then I'll ask the next question. So tell us a little more what you think how is that going to affect investors from a buying decision and even from attaining capital to invest? So say even some of the newer investors or seasoned investors, how much higher is it going to be for them to attain capital?
Well, I think the direct private lending space has been the perfect catch net for investors because the industry has only been around 10 years. So this is a very new industry where a lot of people don't understand the definition of direct private lending and the differences between traditional lending and hard money. And I think rates are relative to how you debt service out the property or how you buy the property, whether it's a rehab to flip or rehab to hold, or it's a turnkey. You're going to be hyper focused on the debt service coverage ratio of the support of the debt leverage to that property, meaning if you have to make 1.2 times more than the debt service of that property to support holding the property. It's no longer looking at you as an income producer. It's looking more at the asset. So I think what you're seeing now, even more than ever, I think investors are penciling harder down on their deals. They're offering less, leveraging less, and growing contingencies with materials more at a 20% variable, more than 10% when they're evaluating their construction costs because of labor shortages, material cost shifts, and supply chain issues that still are there. There's not as bad of supply chain issues, but you have to have those concerns awaiting some of the more vital materials to complete a project. So I think between all of that, I think investors are pivoting and realizing they have to offer less and go in less. And I mean, I'm a transactional investor myself. I'm penciling my deals down harder. I'm looking at a property right now. I'm not looking for anything less than a 2.0 debt service coverage ratio. If I don't meet that, I move on to the next project. I don't need to buy the property. That there's plenty of opportunities that present themselves that have those opportunities.
No, that makes total sense. And what do you see as top 3 trends in the real estate market heading into 2023 as we head inward in the last quarter of this year, really, at this point? What are the top 3 trends you think head going into next year?
I'm thinking that you're going to see a trend of labor force in the lending and real estate force decrease. Okay, you're going to see realtors and loan officers just not be there anymore. I mean, I think we have too many in each industry, and there's going to be an attrition that I think that's probably necessary to support the current volume. You're going to see some consolidation of financial institutions and or direct private lenders. There's already announcements being made till the end of the year. A lot of shifting on the top level of some of the companies. And then I think you're going to see a full pivot going into next year, where it's going to be the year of the landlord, the year of the contractor, identifying opportunities. I think homeownership is going to take a back seat, with rates probably going to be somewhere between 7 and 9%. And based on that, unless it's a matter of necessity, people are going to rather rent. And I think rent is going to level off. So it's going to be a combination of those three items, where rent's going to level off depending on where you're at in the market. And I think that home ownership is going to level off, where the landlord and the contractor are going to be in the forefront of investing of rental opportunities.
No, I think that's definitely some good points for sure. And then on the private financing side, as far as the funding side, what you see is the top 2 or 3 trends heading into this year, really in 2023, and that side of the business, particularly when it comes to funding projects and financing, banking.
Well, I think what's already happening is, I think the leverage is being lessened a little bit depending on the type of project it is, whether it's new construction or renovation. I think rates are obviously moving up, so you're going to pencil your debt service coverage ratio higher and buying better, making money when you buy. And I think there's going to be more of a resume buildup of evaluating an investor to get qualified. Hey, how many deals have you done in the last 24 months? How many current rental properties do you currently own? Do you own your own home? These are just basic questions to build up strategy, to size up. Do I want to work with that client? And now they're going to be able to complete the project they're looking to acquire. If they've never done a renovation before, and they want to do a $200,000 renovation, the first renovation out, and it's more of a lopsided deal, they're probably not going to get approved. They're going to either need the joint venture or partner with somebody that has that level of experience to get into the deal. Okay, so it's all going to be about your last 24 to 36 months of experience, how many rental properties you own, and is your credit score above 660? I mean, I prefer 700, but is your credit score above 660? That's going to be a hard stop right there if some of those questions don't get answered right.
So you think some investors may get flushed out just because their credit scores and the new ones that maybe not enough of the threshold of that.
Mm-hmm.
And so what should people really be looking at as we head into, say, 2023, and the fact that investors, as far as where not only the trends, but where the opportunities are? What's the markets that you're looking at right now that look really good for buying opportunities as we're heading to 2023, and what you see as really strong markets going ahead?
I used to say, hey, stay within an hour of where you live. The old Reader's Digest version, I think that's obviously evolved. I think the real estate professional is now looking at out-of-state opportunities and building out their power team elsewhere, because the barrier of entry sometimes where they are doesn't work for what they're trying to build and scale. So, I look obviously for a strong tax base where the taxes are not, moving very heavy up. Obviously, lighter rehab, keeping under 50% of the purchase price, where you not more of a lipstick on a pig to restabilize, evaluating the area for good landlord-tenant relations, where not saying it's favorable more to one or the other, but at least you got a good, being a landlord and having the proper lease agreement doesn't mean you're going to have a good tenant. So I'd identify markets where you're not going to have tenancy issue and eviction problems, where if it's your first couple of deals, this could be the game changer of you either being a full-time landlord or getting out of the business altogether and just going back to a W-2 opportunity. So I think understanding landlord environment to wherever you're buying is going to be extremely important, because I think when you got people trying to be creative, they get caught because the tenant, sometimes they're professional tenants and they take advantage of those circumstances, and you're going to be the odd man out or odd woman out in that scenario. So I'd be very cautious with landlord tenant laws, especially after post-COVID-19. How many people took advantage of landlords in the past 24 to 36 months, knowing they couldn't be evicted, knowing the government put a stranglehold on the landlords, and now it's just a different environment.
No, that makes a lot of sense. I think that's some great tips and trends as we head in. And tell people a little more about Lending One and how they can get a hold of you and some of the great programs you have to offer investors to help them finance and really make the deals a reality and happen.
Well, I always put a call to action. Listen, if you want to sit down with me for 15 minutes and kind of figure out who you are, what you do, what is your why into the investment space, I will figure out how to pivot and strategize and enhancing your financial resume to get you to the right direction. Two, Lending One is owned by Blackstone Capital, which is probably one of the largest hedge funds in the country that is lending money into the asset-based lending space. So we're extremely strong in the debt service coverage ratio environment, rental loans, bridge financing, new construction, multifamily, revolving construction lines of credit. And I can discuss those options with anybody from a newbie to the expert investor. I could always be reached directly at 215-290-5108 or my email, jscorese, that's JSCORESE at lendingone, all spelled out, .com.
Well, I want to thank Joseph Scorese from Lending One for joining us here at the High Performance Success podcast today. And definitely reach out to Joseph and find out more about his programs with Lending One. Thank you again.
Thank you, Jason.